All right. Good morning, everybody. We're almost through with the week. Getting a little closer. We got some announcements coming from the White House today. That's going to be something you want to keep your eye on. Otherwise, things to the upside are basically flat. You got Japan around 0.25%, but otherwise, that's the top side leader, and from there, it's all downhill. So the S&P right behind it, the Nasdaq below that. Then we got the Dow, and then small caps basically flat. UK, um, they were supposed to do a rate decision today, and I think the consensus was they were going to pause. They have been running quarter point rate cuts, and now I think they're going to hold at 4. Shouldn't be a surprise. They do a really good job of telegraphing what they're going to do. We have some data that we're not going to get. Job openings, factory orders, US trade deficit, all of that should have been in today, and it's not going to. You see the little asterisks here indicating that we're not going to get it. We've got one of the Fed speakers chipping teeth this morning, and I believe we got more happening later. Um, if you go to finance juice, the list is long, right? So we got Barr, Hammock, Waller, Paulson. It just keeps going, and they're all just saying the same old thing, nothing new. They just got to get on record of saying, yeah, they agree with Joey, and Joey got on the record and said he agrees with Sally, and they're all just agreeing with each other. Not helpful. So here's an announcement at 11 o'clock. I know it says 10, but this website uses your local time zone. I don't live on the East Coast, so it's using my time zone. It's 11 o'clock. We'll get an announcement out of Trump, and then later in the day, there's a meeting. Right? It's 1800 at 6 o'clock. Unless we get some gotcha surprise from the announcement at 11, the afternoon should be pretty quiet, right? Pretty laid back. Sorry, I had to dim those white pages this morning. It's just too bright, too bright. All right, we can see the CTA positioning still the same as it was, like nothing changed at all. Same thing with the NASDAQ. They're still holding out up here until we break down or break out of this little range that we've developed here. Then there's just nothing to see here. If it was looking something like this, where the move continues to expand, then we would have something to look at. Even gold is on its way back up a little bit, right? So it could be just like this spot here and this spot here, a little reflexive jerk to the upside before the next leg lower. We don't know yet, right? But at least it is a move in the other direction compared to what we have been doing. We can see the 2 year in this tight little consolidation here. And I bring up the 2 year because of the gamma briefing. So this is Gamma Lab. They do a little briefing in the morning. Talked about that rebound yesterday and the afternoon murder of NASDAQ NVIDIA. And then they mentioned the 2 year note closing 5 basis points higher after we got that ADP number. So we closed at 68.11 cog line. and you can see what we have to the upside. See if we can zoom in on this thing just a little bit. Yeah, feel me now. So there's 6,800. That's just below us, right? And we talk about positive and negative gamma zones and how we can go down and get positive and go up and get negative. We're in that sort of transition phase area when you're right around that zone. Now, if we continued to go up, then we would just be in pure positive gamma. And if we got far enough to the downside, we'd be in negative gamma. But we're just in this little range here. To the upside, we got a big roadblock, 6,850. And we got a little bit of a support underneath us at 6,800. And this is the SPX. It's not the ES that we're talking about here. Snap and Perplexity announced a partnership to integrate Perplexity's AI-powered answer engine into Snapchat. Yeah, okay. If you're wondering why I didn't share the founder's note and the snapshot this morning, I normally take a picture of this. The date hasn't changed yet. So I don't want to, send out a picture of the levels yet until we get an updated levels. Same thing with the integration, the text document that has the Thinkorswim levels. It's still dated with yesterday's dates. Now, on the one hand, maybe that's because the levels didn't change, and so they're just keeping it as is. I've seen this happen before, and they just ended up changing it late, right? It came in around 9 or so. So I'm gonna wait. I'll share it with you guys when I get it. So we are underneath the 3 and the 10. We're back above the 20. You can see here on the daily how we're lined up with that 310 cross right here. Now, I mentioned the other day, what we're looking for is like a TRB, a move back up into that 69.50 area. And if we just work our way back up there with 3 or 4 or 5 candles, it's not going to be a TRB, right? That's just going to be more of like a scoop pattern. So it would look, something like that, and it would take some time. A TRB, on the other hand, would get it done in 1 bar, maybe 2. So we could base here for a few days, like end the week in this level, and then make a shot next week, get a nice gap up to start on a Sunday night, Monday, and then just make the whole run back up here in a single shot. I would like that the best. Here's an example of just grinding our way back up, just more of like a scoop pattern. But with either one of those, we can build a base. This was a 2-day base before we started to work our way back out. That base could be wide and violent, and it could last more than a week. So at the moment, we're inside of yesterday's range. That has to change before we get anything else done. And a line in the sand to all of this is the midpoint of yesterday. We're above it. Looks like we tested it. I mean, not to the tick, but we tested that mid. We tested the 20. We're above all of that, pushing to the upside. We're above our own open, which made the candle green. And now we've got the 10 and the 3 overhead. Once we break yesterday's high, then it's game on, and we can start focusing on all these other levels. If we're running like an OCR style approach, then each one of these was lower highs and lower lows. And then we had this one, the higher low and a higher close, a bit of a transition on the move. Then the continuation with the lower highs and the lower lows. And then here we are now. So after that transition day, we've been running lower highs and lower lows, and we're looking for all of that to change today. It doesn't have to, right? We can spend the rest of the week right here in this box and not do anything. Which direction we leave the box is going to determine what we've got lined up for us next. If we're going to go back to 69.50, or if we're going to go to 66.50 and then 65.50. Being inside day inside of a really big range isn't inspiring. It doesn't provide, any sort of squeeze or anything like that. It doesn't lower volatility metrics. It doesn't offer us anything. It's just a real big, wide, sloppy range. So we got to get out of this. But we got a nice structure with that line underneath us. 6,800 is also the midpoint of yesterday, and it lines up really nice with that 6811 cog line, which is the 20-period daily moving average. So that's a lot of things right around that 6,800 level. We've tested it twice, here on the 4th, again on the 5th, and we're above it. We need to stay above it. Third time's a charm. I think if we get back underneath it again, they're going to wash it. That should put us down into like 67.50 with an overshoot into 6,700, which is the 50-period daily moving average, this orange line down here. 6711 cog line is the 50, and that's close enough to 6,700 that we would just call it 6,700. Lines up well with this pivot low back here, which was 6692 cog line. Gotta love those cog lines. They're everywhere. So GTFO, right? We got to get out of the box to do anything else. And at this point, I would cut that box in half and say, we got to get out of this. Either we break the 6850 and make a run for it, get our TRB, or we break 6800 and we make a run for it and we get this 50 done. The third scenario is that we stay inside the box. We don't get nothing for the rest of the week. This volatility trigger and zero gamma and these other levels, they are from yesterday. They're not today's levels. So don't trust those. As I pointed out a few minutes ago, the website isn't updated with today's levels, so I can't put them on the chart. Okay. We got 67,000 for the overnight volume. That's more within our normal range. Maybe a smidge high, because in the mid 50s is good, good normal. This is still good, just slightly elevated. Not enough to even really worry about, and that really just nothing. We do not have a market maker move this morning, so they aren't sitting out in worry or fear. They're not hedging up. Got nothing at this point. There was a really good question from someone the other day, just kind of new to all of this, and they were asking about this hedging comment that I make and how we know that they're hedging and what the heck are they hedging with, right? Fair comment, very fair question. You see this market maker move signal. I think it was right there on the cues. Let's go back to that. When Thinkorswim recognizes that there's a market maker move, it'll put it right here, right? And then if there's not a market maker move, there's just nothing there, which I've argued with them and sent emails about it and everything, that they should leave the MMM in place. And if there is no market maker move, just put a 0 there. Don't make the whole thing disappear, because then you get new people who think they accidentally turned it off or something. Because if there is no MMM, the whole thing is gone. When they are hedging in the front end, they are using what we call 0-day options, because this is the front end of the options curve, right? That one. When that number is bigger than the next number in line, you'll get a market maker move. Well, what makes this number bigger and smaller? It's out of the money options that are being traded in this expiration. So if they come in and they're hitting these out of the money options hard and fast, the pace of the trades, the size of the trades, and the frequency of the trades are what will change the implied volatility average here on the right. Now, it's proprietary. They don't tell us all the little secret ingredients to how they get this number. But we know that it has to do with the out of the money options and how big the trade is, how often the trade is, and how many of the trades there were. And it has to do with the square root of time based on, how many days to expiration we have. All of that comes into play to determine what this number is. So if they come in here and start hitting these out of the money options and they're hitting them hard and fast and frequent, they'll jack up the implied vol average on that expiration, which makes it higher than the others. And then we get a market maker move. And they do that in the 0-day in the front. And we know that they're hedging because of that. And futures options trade. If the futures are open, the options are open, which is fantastic, because then you can trade options with no PDT 23 hours a day, and you can trade naked options like, a short call, a short put, with way less margin than you need to do with, say, SPY or the Qs. If you're running the MES, you can run MES naked puts, like sell puts to open, with less than $10,000 account. That's fantastic, right? Be able to run short puts and short calls with less than 10,000, and can't do that with SPY, right? With SPY, you need like 170,000, 130,000, something like that, just for one put. It's crazy. So that's where the market maker move comes from. If you was to Google market maker move, Schwab took all of the TD Ameritrade articles that used to be out there about the market maker move. There used to be like a dozen or so, and consolidated them all into one article. And you'll find that if you Google market maker move. You don't need an account at Schwab to read that article. And they don't mention futures at all. They only talk about earnings and how earnings in the front end can jack the vol up and there's a market maker move. But once you understand what the device is doing and what the indicator is searching for, then you can put it on whatever product you want, like the futures, and realize what they're doing. So they're not hedging this morning. Don't get me wrong, they're always hedged, right? It's not like they're running around naked with no hedge. But they're not putting on any additional hedges. Unless we get some gotcha headline, it's very likely we stay in our ADR range today. We don't really have any reason not to, right? What's the catalyst that's going to kick us out of bed? At this point, I don't see anything. If we do get that boot out of bed, then we can try that TRB and get back up 69.50, right? Or to the downside, as we've discussed. I hear everybody looking to the downside and wondering when the crash is coming. And I don't know. I would say it's more likely that we go up before we go down, right? Or if we go down, then it's like a little bit of a capitulation low and then the reversal that we've talked about before, right? Whenever I draw that one, that. If you've been around for a while, you know what that is. And if you haven't been around a while, well, settle in. You'll get used to it. We've only been doing these for a couple of years, so it hasn't caught on yet. Not like South Park. How long has South Park been running now? 15 years? Today's floor pivot is lower than yesterday. That's bearish. Price opened above it. That's bullish. We've already hit it. So we don't have an expectation that we'll drag down to get to it. If you had to Google it, then you cheated, right? You're supposed to be able to answer that one without Google. The R line is farther away than the S line. Even the market math says going up is more likely than going down. Still, that's not a guarantee of anything. This indicator doesn't make price move. It's just giving you a mathematical equation that says it's more likely that we go up than down. And not by much either. The edge is slim. Still, R1 is 74, 68.74, and S1 is 67.64. So what, about 110 points away? That's not bad. What was the ADR? 90? So the S&R line today is just a little bit bigger than the average daily range. And I'll contend, that we don't have any reason to do anything. We can just hang out today. The distribution is getting more and more ugly. If we do make a shot to the upside, that 69.50 is going to be really hard to get through because of this 68.92 cog line, this area up here. So this zone, we got the point of control from last week, and then you got this high volume node of this week. That's going to be a serious roadblock to trying to make our way through that level. All of these wicks down here, when it was getting defended and we were above it, then that finally failed, and now we're underneath it. We got a rejection here. We got a rejection here. Although that's a higher one than this one. We're working our way back through it. If we can get these higher lows and get back through that on the other side, get through this shallow area, then we've got that roadblock, 68.92 cog line. It's the last thing in our way. We get through that, 69.32, and then 69.50. All we got to do is get through this 68.60 and make a run towards 92 cog. We do have the point of control underneath this, and after that it starts to get shallow again. So this zone stretches down into 67.92, and then it gets really thin. So I wouldn't expect a lot of help down here. Look at that reversal. Well, if we had a reversal like that on the 5-minute, that'd be fantastic, right? That's like candle porn. My goodness. We got 43 days left. The December series contracts are running around 60 points, right? Between the December and the March series. So the market is still looking up when we look farther out in time. They're not looking down. Ten-day, 30-minute volume profile in TPO. Little bit of a transition here. At this point, we don't have clarity on this pop up. Is this going to end up being a lower high with structure and then we make a new low? Or is this what we're going to use for the base and the turnaround and get our TRB and run back up? We don't know yet. That's where the trouble is at. To the upside, though, we got this point of control. It's not expected to move this week, maybe mid next week, so Tuesday, Wednesday, if we continue to hang out in this spot. If we break this high and put prints back in at this level, then we're going to extend the life of that level. And very likely this lower one won't ever get this point of control. So it would be nice if we could hang out here for another 2 days, put a lot of work in, the point of control gets brought down to us, and then it's not over our head anymore. So when we make a run to the upside, we're lifting from that level, kind of like pushing off of it rather than having it over our head. We just need another day or two. The candles that made that level, we got a little bit here, which we would start getting into by Monday of next week. But otherwise, the bulk of that volume was done an entire week away, right? So we would need a whole other week to start wiping those candles off the board. That's not going to work, right? We're going to need to build out a new level higher than that level and just take it from there rather than having it fade and get moved. All right, the VPOC from back here got taken out. We left it on yesterday. And I don't know, technically it got hit. It shouldn't have been there, but I left it on because I think it had some value to it. We got near it a couple times without actually hitting it. And then the one time we did hit it, it was a first touch rejection play. This one didn't give very much, but first touch rejection is just like it sounds. We got there, took a very minor rejection, and then we ran right back up and ran through it. So sometimes you get more out of it than just one single tiny pullback. Other times you don't get a pullback at all, right? It just run right through. But yeah, it didn't hurt to leave it on there. So you never know what you're going to get at that level. So we're done with that one. And then we had this one from the 23rd. We took that one out too. So we're done with that. We do have a new VPOC from yesterday. And it's put in across those highs. If it wasn't for this other distribution down here, this would have been a more classic pattern. It would probably be a good idea to take a look at this pattern with just the RTH on there, in which case it looks like it would be perhaps more of a double distribution, right? It would have this lower one and the upper one, because I don't think you would have this with just that little bit of work right there. So 68.50, that's where the VPOC is. I'm not going to get it down to the tick. I'm close enough. And I wouldn't even worry about the one personally. It's 68.50 is the number you want to worry about. So if we make a run to the upside, we've got to get through that level. Our point of control for this morning, this is a really nice D-shaped classic distribution. It's lining up on this level back here. So now that we're above that, we want to keep it. We do not want to give that back. We are 2% above the 10-week. It's a good, healthy spot to be. There's nothing wrong with it. We're not in any way looking for any sort of mean reversion on the higher time frames. And on the daily, we're basically at the 10. That's not bullish or bearish. It's just kind of neutral. If you see the way price behaves around the 10 in the regular trading session, how the uh, options volume changes, the implied vol changes, the way the candles develop, it all changes. It's like this strip of safety, this zone or range where price behaves differently and the orders come in differently. But it's not a negative, not necessarily a positive. It's just it's not a bad thing. So we can hang out here in this sort of safety zone and he'll digest, build up energy or inertia before the next run. Either way, this isn't a bad thing. And we talked about earlier in the week the idea that we might dip down below the zero line and then work our way back out of it again. Okay, well, we did that, right? So now we're back. We don't want to get underneath the zero and get outside of that range. This imaginary collar that we've talked about before, 0.5% below, 0.5% above. That's my collar. Now that we're back on the upside, we don't want to go back down and then push below the low end of that collar. We don't want to see like a -1 or -1.5. We're likely to pick up speed to the downside if we start getting that sort of behavior. The weekly expected move range low held so far. We only tested it once, but that that's all we needed. It's likely if we go back down there and challenge it again that it breaks. Still, it's yesterday's range. We would have to break the mid of yesterday and then challenge the low of yesterday, and the range low 67.66. Kind of keep that on your radar. We got a 70% chance of closing inside this box, right? Because this box is a 1 standard deviation. Looking at things that are down this morning, it's a pretty low list, and it's almost all in the same class, Bitcoin. We kind of really want Bitcoin to be up as a liquidity tell on risk, right? It is one of the most riskiest assets. So if they're trading that, they're willing to take risk, right? We are, quote, risk on. If they're not willing to trade that, why would they take risk in anything else? So Bitcoin is down. And then we got a bunch of stuff that doesn't meet our requirements of a 0.5%. And then a little bit down here at the bottom of things that are up a 0.5%. We got chips, China, gold, gold miners, solar, precious metals, metals and mining, and quantum. It's not what we want, right? It's some of what we want, but not enough. We're just greedy. Having China in there is a good tell, and having chips in there is really good for us. But chips by itself can't be expected to carry the whole load by all on its own. So we want to see things begin to participate because we have the chips. Consumer discretionary, more broader tech, cloud computing would be a good one. The SMRs and uranium plays, those guys, the data center stuff, something more than just chips. And of course, having gold coming back implies that the dollar's taken that pause. Yeah. Quit beeping at me. Yeah. So we had that sort of micro double top 111, 1236 reversal. And now we've made a move to the downside back below 100. Keep the dollar pointing to the downside, and you could get that recovery in gold. the thing is, we don't want the dollar crashing and burning, right? We just want A, to stop moving higher, and then B, to slowly work its way back down. No rash, fast, sudden moves, because that's just going to freak people out. So it's a good start. Might have an opportunity with silver, gold miners, all that good stuff. You don't want a rally day based on pot stocks and solar. And nat gas is leading. And then we've got junior miners, China again, miners, solar, silver, ag, crude, chips. So it's a good start, right? We can see tech is up, just not enough up. So we want more tech, more Mag 7. That top T, that's a nice ETF to use. Something like that one. Mags. So if we're going to get that rally day, it's GTFO, as it always is, right? Always. This was our range. We're trying to break out of it now. So get out of the box, challenge the top. You got yesterday's RTH. And then you've got all of yesterday. Now, all of yesterday is only going to count if we go to the downside, but you can see the levels and the layers right there. Get the heck out of this box and either challenge the top or challenge the RTH low. And once we get through that low, then we've got all of yesterday's low and then another 111 and another 1236, because you got 111 and 1236 right here. If we get through that, then we'll have the other one right there. Cool. Simple enough. Easy. Just got to get out of the box. That's what I got for you guys. Be careful, be safe, have a good day, keep your eye on the clock, make some money.